Imagine this for a second. You're standing on the factory floor of, say, a major EV manufacturer, anywhere in the US, maybe Europe, maybe even in Asia.
Yep.
And you hear that sound, that loud, rhythmic, almost comforting clanking of the assembly line. It's the sound of progress, right? The
Right.
sound of the global economy moving.
It's the sound of money being made.
Exactly. And then all of a sudden, it just stops. It doesn't sputter out. It doesn't fade away. It grinds to this jarring, dead silence.
And that silence it's uncomfortable. It's
Huh.
expensive. You've got unfinished cars, wind turbine parts, missile guidance systems just sitting there, frozen.
And the reason for that silence, that's the scary part. It's not a recession. It's not a union strike or some power failure.
No, it would be because a single decision made thousands of miles away turned off the tap on a tiny, almost invisible pinch of metal.
That's it, a pinch of metal. We're talking about rare earth elements. Without these, the incredibly powerful lightweight magnets that are the absolute heart of modern technology, they just can't be made.
And we need to be clear what we mean by heart of modern technology. We're talking about the permanent magnet motors in your EV, the generators inside those massive offshore wind turbines, even the sophisticated tracking systems in an F-35 fighter jet.
So this isn't just, a supply chain issue. This isn't a logistical hiccup.
No. This is the difference between a traffic jam and a hostage situation. Your entire advanced economy is being deliberately held hostage. This is full-blown economic weaponization.
And that distinction, that's the whole reason we're doing this deep dive today.
It's the only way to look at it.
Yeah.
If you're still thinking in terms of supply chain logistics, you are missing the monumental stakes here. These minerals, they're like the essential vitamins for technology. Without them, everything we rely on for efficiency and power just stops.
Which means whoever controls the flow of those vitamins, they basically control the pace of the green energy transition. They hold the keys to the future balance of military power.
It's that serious.
And that brings us to our mission. We are going to decode this global invisible war for these critical minerals. And we're going to put one company right in the center of the spotlight. Energy Fuels Inc., ticker symbol UUUU.
We're going to unpack the sources you shared and really get into UU's unique two-pronged strategy, because we need to answer the big question here.
Is this company just another mining stock, that goes up and down with commodity prices?
Or is it something much, much more important? Is it an insurance policy for the entire Western world backed by almost $1 billion in cash that is betting the entire house on American industrial independence?
Okay, so let's get into it. To really understand why anyone would call a mining company an insurance policy, we have to go back in time. We have to find patient zero for this entire geopolitical panic.
And that takes us back to September 7th, 2010.
On the surface, what happened that day looks like a really minor event, almost a non-story.
Right, it was a maritime incident in the East China Sea. You had a Chinese fishing trawler, the Minjinyu 5179, and it collides with a couple of Japanese Coast Guard vessels. It's near some disputed islands, the Senkakus.
Oh, it looks like a diplomatic spat, a territorial argument that got a little out of hand. Japan detains the Chinese captain. End of story. Right.
Wrong. The aftermath was the real story. And it was silent, but it was absolutely terrifying. In response, China quietly, unofficially, just stopped all exports of rare earth elements to Japan.
And when you say unofficially?
I mean, there was no press release, no government declaration. The shipments just stopped. The ports stopped loading the ships bound for Japan. It was a silent embargo.
And for a country like Japan with its massive high-tech manufacturing sector, we're talking Toyota, Panasonic, all the big names, that must have been catastrophic.
Think about it. Japan relied on China for something like 90% of its total RE supply. 90%. So when that tap got turned off, the market didn't just get volatile, it exploded.
Exploded is the only word for it. The data we have shows that prices for the most critical elements, things like neodymium and dysprosium,
The ones you absolutely need for the magnets.
they surged. Not 10%, not 20%. They went up anywhere from 500 to, in some cases, a staggering 1,000%.
1,000%. Overnight.
Can you imagine being in a boardroom in Tokyo or Detroit and seeing that number?
It was pure panic. Complete and utter panic. You had Japanese automakers, electronics giants, defense contractors, all of them suddenly facing the reality that their entire production line could freeze. Not because of money, not because of labor, but because of a few grams of metal they couldn't get.
And that single event, more than anything else, was the moment the Pentagon, the EU, every major Western power looked around and realized they had built their entire modern economy on a massive single point of failure.
They had outsourced their own security.
And that day led to three, I think, fundamental realizations that have changed everything since. The first one was just busting the myth of the name itself, rare earths.
Yes, that's a great place to start, because we learned definitively that rare earths are not actually rare.
It's such a misleading name.
It is. They're actually pretty abundant in the Earth's crust. The name is a historical accident, basically. It's stuck because while they're all over the place, they're rarely found in concentrations that are high enough to be economically worth mining.
So they're rarely concentrated, not rarely existing.
Precisely. Digging them up isn't the problem. But that leads to the second big realization.
Which is their incredible importance. Even if the rocks are common, these elements are, like you said, the vitamins of modern tech.
They're the magic ingredient.
Yeah.
You can have all the steel and copper you want, but without that tiny pinch of neodymium or dysprosium, your high-tech magnet is just a lump of metal. Your EV motor doesn't work. Your missile guidance system fails.
And that brings us to the third and most critical realization. The one that created this entire strategic crisis. It's not about the mining, it's about the processing.
This is the absolute key to the whole story. China controls maybe 60 to 70% of the actual mining, the raw production, but, and this is the number that matters, they control over 90% of the processing.
So just to break that down for everyone, digging the rocks out of the ground is one thing.
That's the easy part, relatively speaking.
But turning that rock into the high-purity, usable industrial material, that's the hard part.
That is the incredibly difficult, specialized, messy, and environmentally challenging chemistry. And for decades, the West just outsourced it. We handed that entire critical industry over to China because it was cheaper and easier.
We basically gave them a global monopoly on the most important factory floor in the world, assuming that, global trade would always be smooth and efficient.
And that assumption died on September 7th, 2010. It became crystal clear that this wasn't about logistics anymore. It had fundamentally shifted to a question of national security.
Which is why we see this scramble now. The U.S. government, the Department of Defense, they're not just encouraging domestic production, they're actively funding it. Building a secure, decoupled supply chain isn't just an economic goal anymore.
It's a strategic defense imperative. It's driven by the fear of that silent assembly line we started with. And that single idea defines the entire reason a company like Energy Fuels even has a story to tell.
Okay, so that's the context. A desperate government-backed race to break free from China's 90+% processing chokehold. Now let's bring in the company at the heart of this, Energy Fuels, or UUUU. You mentioned it has this dual identity, which is key to its whole strategy.
It is. It's the bedrock of everything they're doing. Because on one hand, UUUU is, and has been for a long time, the largest producer of uranium in the United States.
So they have a real established business. This isn't some startup with a slide deck and a dream.
Not at all. This is their cash engine, their core business. And it's a critical point because it separates them from all the other purely speculative rare earth startups out there. They have revenue. They have operations.
And that uranium business itself is in a pretty good spot right now with the global push for nuclear power.
It's in a fantastic spot. You have this global renaissance for carbon-free baseload power. You have renewed interest in small modular reactors, SMRs. Even the U.S. government is looking to rebuild its own strategic uranium reserves.
So their core business is stable and growing.
It's strong. The numbers show they're on track to produce up to 1 million pounds of uranium in 2025. That's a steady, politically essential business. So you can think of that uranium operation as this reliable engine that provides the cash flow and the stability for everything else.
And they're using that stability, that cash flow from uranium to fund this massive, you could say speculative, bet on rare earths.
That's the pivot. The RE initiative is the high-risk, high-reward future growth driver.
Yeah.
And it's an incredibly smart way to do it. They're using existing assets and existing cash to shoulder the immense cost of this transformation.
And this entire bet, this future growth story, it all hinges on one single asset, their unique, unbreachable moat, the White Mesa Mill in Utah.
That's it. Everything comes back to White Mesa.
So for someone not in the mining or chemical space, what's so special about this one facility? Why can't a competitor just, build another one?
Because you can't. That's the core of the moat. White Mesa is the only conventional uranium mill currently operating in the entire United States.
The only one.
The only one. And to understand why that's so important, you have to understand what it takes to build a facility like this from scratch today. We're talking about complex chemical processing, which creates industrial waste streams, and it's all under immense regulatory oversight.
So if I wanted to build a new White Mesa mill today, what would that look like? What's the process?
A nightmare, honestly. It would be a decade-long process, minimum, and that's if you had the billions in capital ready to go. You'd need dozens of state and federal EPA permits. You'd have to battle local zoning boards. You'd need to solve incredibly complex waste disposal regulations, especially since some of these materials have radioactive elements.
And you'd have the whole not in my backyard problem.
Oh, absolutely. The NIMBYism would be intense. Trying to get a local community to approve a major new industrial chemical plant. Good luck.
Yeah.
Energy Fuels already has the plant, they have the permits, they have the licenses, and critically, they have decades of experience with the complex chemistry involved, specifically hydrometallurgy.
Hydrometallurgy, that sounds very technical. Break that down for us.
It just means wet chemistry. Instead of the old school way, pyrometallurgy, where you use immense heat to smelt the rock, you're essentially dissolving the mined ore in a series of specialized chemical liquids.
So you're making a kind of rock soup.
A very complex rock soup, yes. And then you use other advanced chemical processes like solvent extraction to pull out the specific metals you want from that liquid. It's highly specialized, and White Mesa is already licensed and equipped to do it.
Which brings us to the kitchen analogy. They built this kitchen to cook uranium using these wet chemistry processes.
Right.
And now they're just retooling that same kitchen with all the permits already in place to cook something new, something far more strategic, heavy rare earth elements.
Exactly. And we need to make a distinction here, because not all rare earths are the same. A lot of people hear the term and think of light rare earths, things like neodymium and praseodymium.
Those are the workhorses, right? The main ingredients for most standard magnets.
They are. And a company like MP Materials out in California, they're a huge player, but they focus mostly on those light REs. You can think of them as the engine of the green transition.
But UU's focus is different. They're going after the heavy rare earths, the turbocharger, as it was put in one report. We're talking about dysprosium and terbium. Why are these so much more important from a national security perspective?
Because the heavy elements provide a very specific, very critical characteristic, heat resistance.
Okay, what does that mean in practice?
Think about a high-demand application. The motor in an EV running at a top speed on a hot day, or the guidance system inside a military missile. These things get incredibly hot.
Right.
And that operational heat can actually disrupt or even permanently demagnetize a standard magnet made only with light REs. It loses its power. It fails.
So the heavy elements are like a chemical stabilizer.
Precisely. You mix a small amount of dysprosium or terbium into the magnet's alloy, and it allows the magnet to retain its full strength even at extremely high temperatures, sometimes hundreds of degrees Celsius. Without them, your high-performance magnet degrades under stress.
And China currently owns the processing market for these heavy elements.
They have a near-total monopoly, which is why Energy Fuels' latest technical breakthrough was such a massive deal. It's the catalyst that got every serious investor and government agency to sit up and pay attention.
They proved they could do the chemistry.
They proved they could do the really, really hard chemistry. They announced a successful pilot-scale production of dysprosium at 99.9% purity. That's not just a lab result, that's a geopolitical statement. It proves that this complex, fiddly chemistry for the heavy elements can be done right here in the U.S. It moves them from being a company with a plan to a company with proven capability.
And that capability, that plan to scale up, is going to be incredibly expensive. Which brings us to their financial strategy. This isn't a small-time operation. They are making a massive billion-dollar bet.
The scale of the recent capital raise was, frankly, stunning for a company of their size. They went to the market and sold convertible notes, bringing in roughly $700 million in new cash.
$700 million, that's a huge number.
It is. And when you add that to the cash they already had on hand from their uranium business and other investments, you find that the company is sitting on nearly $1 billion in total liquidity.
So why? Why raise that much cash all at once? What does $1 billion in the bank buy you in this particular game?
It buys you time, and it buys you autonomy.
Yeah.
And in this business, those are the same thing as an insurance policy.
How so?
Look, building out a commercial-scale chemical processing supply chain from the ground up is a long, expensive, multi-year process. There are going to be delays. There are going to be market downturns. That $1 billion lets them fund the entire build-out without ever having to go back to the market, without having to dilute shareholders every 6 months, and most importantly, without having to beg traditional banks for loans.
Which means they can operate on their own timeline, not a bank's.
Exactly. It gives them the independence to execute their plan properly without cutting corners because a loan payment is due. It lets them weather any storm China might throw at them.
So let's talk about where that money is going. It's a two-part strategy, right? Building the factory and securing the materials.
That's the plan. First, a huge chunk of that capital is dedicated to the construction and optimization of the commercial-scale factories at White Mesa. Their big target, the date everyone is watching, is late 2026.
And scaling up from a pilot project to a full-blown factory isn't simple.
It's the hardest part. Going from something that fits in a large room to an industrial complex that runs 204/7 is a massive engineering challenge. It requires specialized equipment, custom fabrication, and a lot of trial and error. That costs a lot of money.
And the second part of the plan is making sure they have something to put in that factory, securing the raw materials.
Yes, because they can't afford to be at the mercy of the global spot market for their feedstock. That would defeat the whole purpose. They need to lock down dedicated, reliable supply chains for the raw ore.
So they're using that capital to basically buy up supply from mines in friendly countries.
Exactly. They are investing in and developing mines in places like Australia, Brazil, and parts of Africa to ensure they have a consistent, high-quality feed of rock to process. They're building the entire mine-to-magnet supply chain themselves
Removing all the middlemen.
and securing total control over quality and logistics, from the moment the rock is dug up to the moment the purified metal is ready for magnet manufacturers. It's vertical integration on a global scale.
So you've got the financial capital and the technical plan, but you also mentioned another less obvious moat they're building, the social license to operate.
It might be their most valuable long-term asset, especially for operating in the United States. And we see it most clearly in the landmark agreement they recently signed with the Navajo Nation.
What's the significance of that specific agreement?
It's about history. The Navajo Nation sits on vast lands in the Southwest, which happens to be where a lot of these uranium and other mineral deposits are. And historically, the relationship between mining companies and the Navajo people that's been terrible.
A lot of mistrust there.
Immense mistrust, stemming from decades of environmental disasters and contamination from legacy uranium mining in the mid-20th century that was never properly cleaned up. It left a deep scar.
So this new agreement is about healing that while also creating a stable future.
Precisely. On the surface, the agreement is about the safe transport of uranium ore across Navajo lands to the White Mesa Mill. But what it really does is set a powerful precedent. It shows they're proactively addressing the environmental and trust issues of the past, and it guarantees that the local communities will see real economic benefits, jobs, investment from this development.
And how does that function as a competitive advantage, as a moat?
Because in America today, what's the #1 killer of major resource projects? It's not technical failure, it's not lack of money, it's protests, lawsuits, and local opposition. It's permitting headwinds.
So by having this agreement, they're insulating themselves from that risk.
They're building a defensive wall. When you have a strong, good faith partnership with a powerful sovereign entity like the Navajo Nation, you are protecting your operations from the kinds of regulatory and protest shutdowns that could sideline a competitor for years. That operational stability is priceless.
So that billion-dollar war chest, it's buying the factory, it's buying the global supply chain, and it's buying the political stability to see the whole project through to that 2026 deadline.
It's a comprehensive insurance policy against every conceivable type of failure, technical, financial, and political.
All right, that's a very compelling picture. High stakes, a clear geopolitical need, a smart strategy, and a massive pile of cash. But now we have to bring in the killjoy. We have to look at the cold, hard numbers and the very real risks that come with a bet this big.
Absolutely essential, because for all the talk of 2026, the reality of their financial statements today tells a very different story.
Let's start with the bottom line. Despite the vision, Energy Fuels is currently losing a lot of money.
They are. They are deep in the investment phase, and the financials reflect that. There's no hiding it. If you look at the third quarter of 2025, for example, the company posted a net loss of $16.7 million.
And the operating margins, which are a key indicator of a company's day-to-day health, they look even worse on paper.
They do. The operating margins are deeply negative. Depending on how you calculate it, they're somewhere between minus 144% and minus 621%. Now, for any listener looking at that, we have to put it in context. In a normal, mature company, that's a 5-alarm fire.
But isn't a normal mature company right now. What does that negative margin actually represent in their case?
It represents the burn rate. It's the cost of the transformation. They are spending millions on R&D, on pilot programs, on the engineering plans for the big factories, on securing those global supply contracts. All of that spending is happening now before a single dollar of commercial revenue from the rare earth side of the business comes in.
So they're operating like a high-growth tech startup, just with chemical engineers instead of software developers.
That's a perfect analogy. It's the calculated upfront cost of building that insurance policy. But it leads us directly to the single biggest financial risk for anyone investing today, and that is the valuation premium.
The price of the stock itself.
Yes, if you look at the stock price right now, the company is trading at roughly 40 to 50 times its sales, a 40 to 50x multiple.
Put that in perspective for us. How does that compare to other companies?
Well, a stable, profitable, mature gold mining company, say a Barrick Gold, might trade at 2 or 3 times its sales. A really fast-growing tech company that's already profitable might trade at 15 or 20 times sales.
So 40 to 50 times sales isn't just high, it's in the stratosphere.
It is an extreme premium, and what it tells you is that the market, the investors, they are completely looking past the current uranium business. They're ignoring the negative margins. They're paying a huge price today for profits that they hope might show up in late 2026 or 2027.
So you're not buying the company as it is today, you're buying a belief in the future.
You're buying a story. You're buying a belief in their execution and a belief that the U.S. government will back them with massive long-term contracts. It is a bet on future policy and flawless execution, not current performance.
And making that bet means you have to stare down 3 critical risks. Let's start with the biggest internal one, technical risk. The challenge of scaling that fiddly chemistry.
This is, in my opinion, the #1 hurdle they have to clear. They've proven it works at the pilot scale, in a controlled, lab-like environment. But scaling chemical engineering is notoriously difficult.
It's the difference between baking one perfect cake in your kitchen and running a factory that bakes 10,000 perfect cakes an hour.
Exactly. The devil is always in the scaling. Things that work perfectly in small batches can fail spectacularly at an industrial scale. Pipes corrode faster. Pumps break. Purification levels suddenly become impossible to maintain consistently. Waste streams become more complex and expensive to handle than you projected.
So if they can't get the big factory to run as efficiently as the small pilot project,
Then the whole economic model falls apart. The entire billion-dollar bet rests on their ability to execute that scale-up. If they can't, it doesn't matter how much government support they have. The business fails.
okay, that's the internal risk. What about the external ones? The most unpredictable one has to be the China card.
This is the geopolitical risk you cannot control. And China has a long history of using its market dominance as a weapon.
So the fear is if Energy Fuels actually succeeds.
Right. Let's say it's late 2026. The factory's running. They're producing high-purity dysprosium. The fear is that Beijing could decide to immediately flood the global market with cheap, heavy REs,
A deliberate price war.
a targeted assassination. They could intentionally crash the price, pushing it below Energy Fuels' cost of production. They could bleed them dry, bankrupt the only Western competition, and reestablish their monopoly for another decade.
And they've done this before.
They did in the early 2010s to crush other nascent Western projects. There is absolutely no reason to think they wouldn't do it again if they felt their strategic dominance was truly threatened.
Okay, so you have technical risk and geopolitical risk. The third major risk brings us back to that huge pile of cash they raised. It's a financial risk. Dilution.
Yes, that $700 million didn't come for free. It was raised using something called convertible notes.
Explain what that means for a regular investor.
Think of them as a loan or a bond, but with a special feature. The note is designed to automatically convert from debt into equity, into new shares of stock, if the company's stock price hits a certain predetermined level.
So ironically, if the company is successful and the stock price goes up, that triggers the conversion.
Exactly. The stock price rises, it hits the trigger price, and boom, that $700 million of debt disappears and is replaced by a large number of brand new shares that are issued to the note holders.
Which means there are more slices of the pie.
A lot more slices. The total number of shares outstanding goes up, which means the company's future earnings are now divided among more shares. That reduces or dilutes the value of each individual share that existing investors are holding. It's a necessary evil to raise that kind of capital without a bank, but it puts a cap on the potential upside for long-term shareholders. It's a risk created by their own success.
So After all of that, what's the verdict here? We've gone from the geopolitical panic to the unique moat of White Mesa, the billion-dollar war chest, and now the very serious risks. How do we synthesize all of this?
It boils down to a classic high-risk, high-reward bet. It's a wager on two things. One, that American industrial policy will continue to aggressively favor domestic supply chains. And two, and this is the big one, that the company can execute perfectly on some of the most difficult chemical engineering challenges in the world.
And we have a date, a clear binary moment to watch for.
We do. Everything comes down to late 2026. That is the D-Day for this company. It's the moment we find out if commercial scale production works or if it doesn't. There's really no middle ground.
So what's the bull case? If it all works, what does this company become?
If the factory runs, if the purity is high, if the costs are managed, and if the government contracts roll in, the bull case is just staggering. They become the foundational supplier for America's entire green energy and defense sectors. It could be the Exxon of the electric age. There is no one else in the Western world positioned to do what they're trying to do. They would be a strategically priceless asset.
And the bear case is just as extreme.
Equally dramatic. If they hit those technical scaling problems, or if China plays the China card and crashes the market, that sky-high valuation, that 40 to 50 times sales multiple, it could collapse. And it would collapse fast, leaving investors holding a very expensive bag.
The volatility is just baked in until we get that answer in 2026.
Completely. You are not investing in current profits. You are investing in a vision supported by the stable uranium engine, but it is a vision nonetheless.
And it's important to remember that this invisible war, it affects you whether you invest a single dollar in this company or not. Because there's that old saying, right? Amateurs talk strategy, professionals talk logistics.
And that's what this is all about. The real battle for the future isn't being fought on a battlefield. It's being fought in the complex chemistry inside a processing plant in Utah. The performance, the cost, the very availability of your next phone, your next car, the stability of your power grid. It all depends on the logistics of these tiny pinches of metal.
Energy Fuels has placed a billion-dollar bet that America is finally ready to take control of its own industrial destiny. And I think the final provocative thought to leave you with is this. When you look at that stock price today, you need to remember exactly what you're buying.
You're buying a vision of a perfectly operating factory in late 2026, and you're paying a significant premium for it right now. The story is compelling, but only the successful execution of that fiddly chemistry can turn the story into reality. Keep decoding.